Well, good morning, or good afternoon, or good evening, whatever it happens to be while you're watching this video. And let me offer my welcome to SPI, and I wish all of you the best of luck as you work your way through financial accounting and the rest of SPI. So what I want to talk about in this video is what is known as the accounting cycle. We can see it listed here on the screen, the 8 steps that make up the accounting cycle. And this video will put a good dent in those 8 steps. Okay, so let's get started. This is known as the mechanics of financial accounting. So the whole process starts when what we call a transaction occurs. As we can see here, a transaction is some event that affects the financial condition of a company where items of value are exchanged. In other words, some event happens to a company and it's going to affect their financial statements. So the example we see here, a company borrows $1,000 from the bank. Another one would be you walk into an Apple store and you buy a phone for $1,000. Every other Friday, the company pays their employees their salary. Those are all examples of events that affect the financial condition. And in accounting, we call that a transaction. So what we need to do is understand the nature of that transaction and somehow have that transaction get recorded into the accounting system so it makes its way all the way through to the financial statements. That's our ultimate goal, to prepare a set of financial statements. Okay, so as it notes here, it's important that as accountants we understand the nature of the transaction, exactly how does this event that just occurred affect the financial condition of the company, and then we can get into the mechanics of how do we get that into the system. Okay, so the way we do this, first thing we call this journalizing. What we mean by journalizing or recording a journal entry is to take the necessary data from a transaction and record it somehow. Now, if we were to go back 60 years ago, for the most part, this was done with paper and pencil. These days, everything is computerized or it's scanned, whatever the case may be, but there's some process in place so that when a transaction occurs, it gets recorded into our accounting system. The way we do this is by setting up accounts. So an account is a place where we can record and keep track of and categorize these transactions. So for example, we will have accounts for all of our assets. So there's a cash account, an accounts receivable account, an inventory account. We have them for liabilities, an accounts payable account. We have them for revenue, for expenses, for shareholders' equity accounts. So think of an account as a place where we have a spot where we can record an event if it affects that particular account. So what we can do here, we can create an account and visualize it using what is known as a T account. Okay, so we see one drawn here. So for example, we could create a T account, and there's why we call it a T, and let's say we have one for cash. Okay, and it's split into a left side and right side, right? Here's the left side of the account. Here's the right side of the account. So left and right. In accounting language, we call that debit and credit. So that is all those two terms mean. Debit refers to the left side of an account. Credit refers to the right side of an account. So keep that in mind. So debit's on the left, credit's on the right. Debit's on the left, credit's on the right. In my section, I'll actually show you a short video that will hopefully indelibly record that debit on the left, credit on the right into your mind. Okay, so that's all we mean by it. Debit means left, credit means do something to the right side of an account. Okay, so the way this operates is that it's going to be helpful to go back to the accounting equation. You may recall the accounting equation. Assets equals liabilities plus equity, right? And if we think of this as the left side of the accounting equation and this as the right-hand side of the accounting equation. Okay. And so the reason why this is helpful to think of this in terms of the accounting equation with assets on the left side of the equation, this equation helps us remember what the normal or natural balance of these accounts are. So in other words, assets normally or naturally have a left side balance, or what we call, again, a debit balance. On the other hand, liabilities and equity, they're on the right-hand side of the account, which means those accounts normally or naturally have a right-hand side balance or a credit balance. So again, left debit, right credit. Okay. So we think of assets normally have a debit balance, and liabilities and equity normally have a credit balance. We can then think about how we use the terms debits and credits and our T accounts and the like to record transactions. We increase accounts on their normal side. So what we mean by that is assets are normally have a left side or debit balance, which means that's how we will increase those accounts. So for example, to increase the cash account, we would do that with a debit because that's on the left side of the account, and that's the normal balance for an asset. So if we look at these two T accounts here, one representing assets generically, one representing liabilities and equity, to me, you only have to remember one of these. And at this point, if you want to say you have to memorize this, so be it. So as long as you can remember this one thing, to increase an asset account, you debit it. Just stop right there. That's all you need to memorize. To increase an asset, you debit the asset account. From there, everything flows naturally. So if you think about it, well, you're saying to increase an asset, we debit it. We would do the exact opposite to decrease it, which is why if we want to decrease an asset, we credit it. So notice, again, it flows naturally. If, again, all you do is memorize, to increase an asset, we debit it. If we want to do the opposite, which is decrease, we do it on the opposite side, which is the credit side. Then when we move over to liability and equity accounts, we just completely reverse everything because they are on the other side of the accounting equation. We do the opposite. So again, if we increase an asset with the debit, well, the way we increase a liability or an equity, we do the opposite. We credit it. Okay. And if we increase a liability or equity account with a credit, we would do the opposite to decrease it, which is debit. Okay. So let me just repeat this one more time because this is critical. We'll be doing journal entries from now until the end of the course. So if you can get this down now, you're going to be way ahead of the game. All right. So again, just remember, debits on the left, credits on the right. Think about the accounting equation. A equals L plus E. A is on the left side of the accounting equation. The left side is the debit side, which means assets, the normal balance is the left side balance, which is a debit balance. And we increase accounts on their normal balance side. So that's why, again, we come down here. To increase an asset, we debit it. And if you can remember that, the rest flows naturally. So if you increase an asset, we're debiting it. We do the opposite to decrease it. We credit it. And then for liabilities and equity, we do the exact opposite because they're on the other side of the accounting equation. Okay. So I spent a lot of time on that, but to me, hopefully it's worth spending all that time to make sure you try and get that down as early as possible and you're learning of how debits and credits work. All right. So let's look at an example here. So here's this transaction. a company borrows $1,000 from the bank. Now, one of the things we have to realize is that every time we record a transaction, at least two accounts are affected. At least two accounts are affected. And every time we record journal entries, we have to have equal debits and credits in terms of dollar amounts. So in other words, every time we record a journal entry, the dollar amount of debits will equal the dollar amount of the credits. Okay. This is where the phrase double entry bookkeeping comes from, because every time we record a transaction, at least two accounts are affected. Early on, we'll just see two accounts, but later we'll see transaction with 3 or 4 accounts being affected in one single journal entry. Right? So let's look at this one. And when I think about journal entries, I'm always hoping that cash is involved. Because if cash is involved, first off, remember cash is an asset. So that's sort of easy to remember, right? Cash is an asset. And then we can figure out what happened to cash in this transaction. Did it go up or down? If it goes up, that means we have to increase cash. Cash is an asset. How do we increase it? Again, with the debit. If cash is being paid, if it's going down, decreasing, we would credit it. So in this case, we're borrowing $1,000 from the bank, which means we're getting $1,000 cash from the bank. So record the journal entry. We'll write the name of the account, and then we'll move over to the right-hand side and think about, visualize, if you will, sort of 2 columns over on this right-hand side, representing sort of debit and credit columns, right? So here's the name of the account that we're going to debit. We always write the account to be debited first and its dollar amount, followed by the account to be credited. And when we record the credit account, we indent it. So notice this is not just to make it easier to read. We indent this. We don't write this directly underneath the word for the account that we debited, right? So we're not doing that. We indent the name of the account that we're crediting. And notice when we record the dollar amount, we put it sort of over in another column that we can think of it representing a credit column. Okay. So there's our first journal entry. And the way we would say this, we'd say debit cash $1,000, payable $1,000. And note payable is the account we will use whenever we borrow cash from the bank. It creates a note payable. It's different than an account payable. An account payable, for our purpose, is created when we buy inventory from our vendors on account. In other words, we'll order and receive the inventory now. We'll pay for it at a later date. That creates an accounts payable. So accounts payable is for transaction with our suppliers. Notes payable are for transactions with our bank. Okay. All right. So there's the journal entry. That gets recorded in what we call the journal. So journal is a chronological listing of all the journal entries as all the events as they take place and as we record them. Then what we do is we use the word post. Another way of essentially almost saying copy to the ledger. So a ledger is a separate, if we go back 60 years ago, we had separate books. There was a journal, which is a chronological listing of all the journal entries. Then we have the ledger. A ledger is a listing of all of our accounts. So think of each page in this ledger being for a separate account. So page 1 might be cash. Page 2 might be accounts receivable. And what we do in the ledger, every time there's a transaction that affects that cash, we're going to copy it from the journal entry and post it to the appropriate account in the ledger. So if this is a brand new business, we're starting off with 0. And notice since cash is an asset, and assets, the normal balance is a debit balance, we're going to put this BB, stands for beginning balance. We're going to put it on the debit side of the account. Notes payable is a liability. Okay. And liabilities, they're on the right-hand side of the equation. Right-hand side of the account is the credit side, which means the normal balance is a credit balance. That's why its beginning balance naturally is on the credit side of the account. So to copy this $1,000, that was a debit to cash. So we'll record that as a $1,000 increase to the cash account. And the note payable, we now owe the bank $1,000. So that note payable is now increased. How do we increase a liability? We increase liabilities with a credit, right? So notice again what we did there. We copy them to their appropriate account and to the appropriate debit or credit to that account. And as a reminder, every time we record a journal entry, there must be equal debits and credits. So right now, this journal entry had $1,000 in total debits and $1,000 in total credits. So we're good. Okay. Right. And every time we record a journal entry, it's got to keep the accounting equation in balance. So we go to our accounting equation here, we increase assets by 1,000 and we increase liabilities by 1,000. So it kept the accounting equation in balance. So every time you record a journal entry, got to make sure you're keeping your accounting equation in balance. All right. So now we'll dive into this example that we're going to use for the next several slides, Wildcat Auto. So what Wildcat Auto does is they buy cars and then they resell them. So they're a car dealership. And we'll assume they began business on January 2nd of this year. So Bill Jackson is the owner of this business. And the way many business starts is with the owner contributing $200,000 of his or her cash into the business. In exchange for that, he becomes the owner of the business, and that ownership is represented with shares of stock, shares of common stock. Right? So this is certainly an event that affects Wildcat Auto. So that means it's a transaction, needs to be recorded. So to record this, again, I always look for cash. Fortunately, there's cash here. So $200,000 cash is going to Wildcat Auto, which means cash is going up. How do we record an increase in cash? If we were together, this would be a great time to start calling on people. I'd ask people, what would you do? Hopefully somebody would answer correctly. You would have to debit cash $200,000. Okay. Then I would ask, well, what do you need to credit? Okay. Well, this is not a note payable. We're not borrowing money. So this is common stock. This is an equity account. And we're going to call this simply common stock. So common stock is one of our equity accounts along with retained earnings. Okay. So in this case, common stock, it's equity. Equity is on the right-hand side of the accounting equation. It's going up. Wildcat Auto, before this transaction, had nothing in the common stock account. Now it has to have $200,000. How would he increase that by $200,000? We would credit the common stock account, and notice this indent when we recorded the word for the account to be credited. All right. So we would say debit cash 200,000, credit common stock 200,000. So just by looking at the way that is written, you can get a sense of what just happened here. All right. So this is the beauty, the language that accountants speak in, right? They see that cash is debited, which means it increased. So just by looking at this particular journal entry, if I were to ask you what happened to cash, you should be able to answer cash was increased by $200,000. Then we say, what effect did this have on the accounting equation? So here's again, it's our accounting equation. Assets equals liabilities plus equity, right? A equals L plus E. Notice left side equals right side. So we have the various asset accounts we're going to use in this example: cash, inventory, and buildings. And the liability accounts, we're just going to have one accounts payable. And for the shareholders' equity, we're going to have a common stock and a retained earnings account. So let's look at the effect that this transaction had on the accounting equation. So we see here, again, by looking at the journal entry, cash increased by 200,000. So we're going to just leave off the 0 extra thousands here. So cash is going up 200,000. We do not need to put a plus sign in front of this. You can if you want, no harm in doing so, but we don't need to do that. And so we've got $200,000 increase on the left side. We need to keep the accounting equation in balance. So how can we do this? A couple ways to do this. The way we're going to do it here is by increasing the left-hand side or the right-hand side of the accounting equation under the common stock account. Notice here, $200,000 increase on the left side is equal to a $200,000 increase on the right-hand side. Then a question we'll ask throughout this course again, what's the book value of the firm after this transaction? For now, a simple way to think of book value, it's simply equal to shareholders' equity. So right now, book value would equal total shareholders' equity. If we look at shareholders' equity here, these two accounts together, $200,000. So we say that is the book value of the firm. Okay. Let's continue on to another journal entry. So Wildcat Auto buys a used building that's going to serve as both a retail and office site. They bought the building for $120,000 cash. So again, cash was used here, so this is going to affect the financial condition of the firm. And I'm glad cash is involved here. So in this case, we're paying cash, which means cash is going down. So I need to think, well, if cash is going down, I need to decrease it. Go back to my T accounts. How do they work? Again, assets, I increase those with debits, right? That's the one I said. That's the only one you have to remember. To increase an asset, you debit it. In this case, you want to decrease an asset. So that means we'd have to credit cash. Let's hold off on writing that because we write the credit part of a journal entry second. But we've got that. So we know we're going to credit cash 120,000. We need to debit and have the total debits equal 120,000. So we need to think about, what do we debit here? Well, it looks like building. And why not just use the word there? I mean, you can see down here, we've got building as one of our assets. So that's what happened here. The company now owns a building. A building is an example of an asset. An asset, from your definitions, asset is an item of value owned by the business. Wildcat Auto now owns a building. So they need to record that building at what we paid for it. So we would debit buildings 120,000, and as you already know, we would credit cash. And again, I won't keep talking about this, but just remember to indent and make it very clear that you're indenting that. And the same thing for the dollar amounts. Notice these are separate. These are not written underneath each other. This is sort of indented as well, the dollar amount. Again, think of two separate columns here. I want to think of it, a debit column and a credit column for the dollar amounts as well. Okay. The effect on the accounting equation. Okay. Well, we see buildings increased by 120. Right? And we see cash went down 120. So to record that, an account going down in value, a couple ways we could do this. You could put a minus sign in front of the 120, or in this case, we're going to use parentheses around it to represent that we're decreasing that particular account. So cash is going down 120,000, and what's in this case, again, we need to keep the accounting equation in balance. Two ways of doing that. We could have had something on the right-hand side of the account go down 120, but that's not what happened here. The other way to keep the accounting equation in balance is to have something on the same side of the account sort of balance out what happened so far. So we had one asset account go down 120. Another way to keep the accounting equation in balance is to have another asset account go up 120,000, and that's what happened here. This is an example of what we call an asset exchange. That simply means one asset account went up in value, in this case buildings, and one asset account went down in value, in this example cash. So that's an asset exchange. One asset going up, one asset going down. In terms of how this affect the book value of the firm, again, the book value of the firm, shareholders' equity. Doesn't look like anything happened here, right? No effect. The book value of the firm is still that $200,000 from the first transaction. Okay. Let's keep going here. So what did Wildcat do next? All right, so now they're getting into the nitty gritty of what they do. So you said before, what they do, the heart of their business is buying and selling cars. So they went out and bought 4 cars. Each car cost $20,000, so $80,000 in total. And they bought them on account, which means they did not pay cash. So they did not pay cash. They bought these on account, which means they do have to pay the $80,000 later. But right now, wherever they bought these cars from said, we'll give you the cars now, you can pay us at a later date. So what was exchanged in this transaction? Okay. What was exchanged were we're getting cars in exchange for essentially an IOU. Whoever the supplier is of the cars, we now owe them. Okay. So let's go back and record the journal entry. So let's think about, were any assets affected here? So in this case, these automobiles represent inventory. In our definition of inventory, items, it's an asset, items of value owned by the business that provide a future benefit. So these are inventory because the future benefit they provide is that we're going to sell these, hopefully at a higher price than we paid for them. Right? So this is definitely an asset. Let's give it a name. It's not cash, right? It's not a building we just bought. We bought inventory. So we'll use this particular account name. So what happened to the inventory count? Did it go up or down? Well, in this case, we just got 4 cars. So the inventory count is going up. Inventory is an asset. It's on the left-hand side of the equation. How do we increase items on the left-hand side of the equation? With a debit. So we will debit inventory for the appropriate dollar amount. And then what do we credit here? Again, if it had been cash that we paid, we would have credited cash. In this case, it's not cash. In this case, we owe somebody. We owe the car vendor we bought these automobiles from. We owe them $80,000. When we owe something, that's a liability. And the liability we're going to use here is accounts payable. As I said earlier, we will use accounts payable to represent transactions when we buy inventory on account. It's different than a note payable that we talked about earlier. Notes payable are a transaction with banks. Okay. So we debit inventory. In this case, we will credit accounts payable $80,000. Okay. And yeah, so there's the credit to accounts payable $80,000. The effect on the accounting equation, again, in class is something I would be asking and calling on people. And hopefully first person say, well, inventory needs to be increased 80,000 and accounts payable needs to be increased 80,000. Okay. So notice it kept the accounting equation in balance. An increase of 80 on the left and an increase of 80,000 on the right. So it kept the accounting equation in balance. We don't see the question here, but once again, no effect on the book value of the firm. Book value of the firm still $200,000. All right. So a couple days later, January 7th, they're paying $60,000 towards what they owed for those 4 cars they bought. So they did owe a total of $80,000. Now they're paying $60,000 of that debt. Okay. So we need to record this, an event that affects the financial condition of the firm. So we see cash, we see the word paid. So when you see the phrase paying cash, we know cash is going down. How do we record cash going down? Well, cash is an asset. To record a decrease in an asset, we credit it. So let's keep that in the back of our mind. We're going to have a credit to cash for $60,000, which means we need a debit. We wouldn't debit inventory here. We already recorded the cost of these 4 cars that we bought. We're not buying more cars in this transaction. We're paying the vendor for what we owe. We're paying off part of that account payable. So in the previous transaction, we increased accounts payable to show that we owed $80,000. Now we're paying off some of that. We're decreasing accounts payable. How do we decrease an account payable? Well, account payable, it's a liability. It's on the right-hand side of the account equation. Okay. To decrease liabilities or equity accounts, we debit them. So we would record a debit to accounts payable of 60 and a credit to cash of 60. Right? So debit accounts payable. And again, you should be able to look at this. If I just ask a question, I just debited accounts payable 60,000. Does that mean the balance went up or down? You should be able to answer that question, right? So again, by speaking the language of business, we don't have to use the phrase increase or decrease. We use the phrases debit or credit. And from that, we're able to understand did that account just go up or down? Okay. The effect on the accounting equation, again, cash going down, right? So we'll put it in parentheses, or you could use a minus sign. And accounts payable is also going down. So notice, again, accounting equation is in balance. As a result of that transaction, we decreased the left-hand side of the accounting equation by 60,000, and we decreased the right-hand side of the accounting equation by 60. So it's kept everything in balance in terms of the accounting equation. All right. Now let's do our next step. So right now, all we've done, we've recorded 4 journal entries, right? Next thing we're going to do is, so we've reached the end of a particular time period when we do our posting. And now we're going to post these transactions. So you may recall posting simply means copy from a journal entry to our ledger. The thing of ledger is having a separate page for each account. So here's all the accounts we have. We have a cash account, inventory, buildings, accounts payable, and common stock. So think of our ledger as having 5 pages in it right now. Page 1 is cash. And what we're going to do on that cash page is go through the journal entries, see was cash ever affected. And if it was, and if we can visualize again this book, this ledger, here's this cash page, and we'd have one column that would essentially give the date that the transaction occurred. We'd write some brief description like owner invested cash in business, and then record it in one of 2 columns on that page, either a debit column or a credit column. So you may recall that first transaction, that's what this number 1 means. Our first journal entry was where the owner, Bill Jackson, contributed $200,000 of cash to the business in exchange for common stock. So we would go to this cash page, this cash account. We represent that ledger with a T account. So again, here's that T account, right? We can think of drawing, right? And on the left-hand side are the debits, the right-hand side are the credits. Right? So from the first transaction, we knew we had debited cash $200,000. So that would have gone in the debit column on the T account or in the ledger. And then let's go in the common stock that increased that account. That's an equity. The normal balance for equity accounts is a credit balance. Hence, we increase equity accounts with credit entries. So that would have got recorded sort of in the right-hand column of the page where we list common stock in the ledger, right? So the rest of these we've gone through. Here's journal entry 2, where we bought the building, right? Here's journal entry 3, where we bought the cars. And journal entry 4 is where we paid off part of our account payable. So there's the 4 journal entries. Then once we're finished all of our posting, what we'll do, we'll summarize and calculate what is the ending balance in that account. So this is going to use what I call T account math. And this is one of the more confusing things for students and for some students from now until the end of the course. So I'll try and make sure I hopefully spend enough time explaining how T account math works. It doesn't matter if we're talking about, an asset, liability, or equity account. Essentially works the same for all accounts. The way it works, we'll start with our beginning balance. So whatever side it happens to be on. Remember, the normal balance for assets is the debit balance, the left-hand side of the account. Hence, beginning balance of cash is 0 is on the debit side. Okay, so we take the beginning balance, whatever side it's on. So in this case, cash, the beginning balance is on the left or debit side of the account. Then we add to that any transactions on the same side. So here we start the beginning balance on the debit side, 0. We add any transactions that are also on the debit side, just add 1. So 0 plus 200,000. Then we subtract any transactions on the other side of the account. In this case, on the credit side. So again, to reiterate, the way we do T account math, we start with our beginning balance, add to it any transactions on the same side as the beginning balance, and then subtract any transactions on the other side. So in this case, 0 plus 200,000 minus 120 minus 60, so that's a total of minus 180,000. We're left with $20,000. And overall, if you want to think of it this way, when we added 0 and 200,000 together, we had $200,000 in debits. We have $180,000 in credits. So we net those two against each other, and we're left with more debit balance than credit balance in the amount of $20,000. So $200,000 in debits, $180,000 in credits, leaving us with an ending balance of 20. And that's we would expect. Cash is an asset. The normal balance should be on the debit side of the account. Okay. Let's look at accounts payable. See how this works, because this is a credit. This is a liability account, right? So accounts payable, notice its beginning balance is on the credit side. So that's where we start to do T account math. Start the beginning balance, add any transactions on the same side as that beginning balance. So 0 plus 80. So right now I have a total of $80,000 credit balance. And then subtract any transactions on the other side. On the other side, I've got this debit of 60, which reduces the account. So we have 0 plus 80 minus 60, leaving me with $20,000 credit balance. This is a $20,000 credit balance, and that's what we would expect for liability to have a credit or right-hand side balance. Okay. So that's step 3. So step 1, again, understand the nature of the transaction that just occurred. Step 2, record it. Step 3, post it. Next step, prepare an unadjusted trial balance. This is not a formal financial statement. The purpose of the unadjusted trial balance is that before we start going too far in the accounting cycle, let's make sure it looks like we're on the right track. So all we do with the trial balance is we take all of our accounts, and we normally list all your assets, your liabilities, and then your equity accounts. So we list them all. That's what we're doing here. List all the accounts. And then from these T accounts, take what their ending balances are. So cash is an ending debit balance of 20,000. So we'll set up two columns here, a debit column and a credit column. And we'll record, well, cash at a $20,000 debit balance. If we look at accounts payable had a $20,000 credit balance. So here's accounts payable, $20,000 credit balance. So you do this for every account. Then we add up the debit column, add up the credit column, and these two numbers have to equal. I'm not saying they will equal when you do your first unadjusted trial balance, but before you can go any further, you've got to make sure that these two numbers equal each other. And really, if you've done everything correct, if you started with everything okay, and this is a brand new business, so everything was at zero. So certainly your accounting equation was correct to start. So all debits and credits were equal. They were all zeros before this business got started. And then we went through, and every time we recorded a transaction, we made sure that debits equal credits. If we did that correctly, and then you did your posting correctly, then this sort of has to be guaranteed that these two numbers would equal each other. Okay. Now, what if it doesn't equal? The chances are when you start doing this, things may not work out. If total debits don't equal total credits, it means something's wrong. You made a mistake. You may have reversed something. So maybe when you paid off that accounts payable, maybe you debited cash and credited accounts payable for 60,000. That's going to throw everything off, right? So you have to go back and check everything. Go back, start with your journal entries. Does everything appear okay there? The journal entries appear correct. Look to see, did you do your posting correctly? If it looks like you did your posting correctly, then make sure that you did your T account math correctly. Those are sort of the steps to go through. Okay. So some resolved balances, everything's okay. We can keep moving on. Okay. All right. So let's just look at a balance sheet as of right now, the end of these 4 transactions. So in the balance sheet, we list our assets, liabilities, and equity. They're the 3 sections. Okay. So we can get all this from our trial balance, right? So a cash at a balance of 20, inventory at a balance of 80, buildings at a balance of 120. So that's where these dollar amounts are coming from. Okay. So there's our 3 assets: cash, inventory, and buildings. Those total 220. Our liabilities, we only had 1, accounts payable. We got that from our trial balance. Accounts payable, 20,000. And the common stock account, part of shareholders' equity, that was 200,000. Notice we don't write the words debits and credits on the balance sheet. In fact, as we'll see later on, this is one format of a balance sheet. More typically, we'll see a balance sheet just being written straight down. Assets listed first, right underneath that liabilities, right underneath that the equity accounts. So there really wouldn't be sort of debits and credits, to be straight down in the same column. All right, so the balance sheet doesn't have any mention of debits and credits. You're just putting the accounts where they belong, asset, liability, or equity, and what their dollar amount is. And then again, if everything's been done correctly, your accounting equation A equals L plus E should work. All right, so let's ask some questions. Book value of the firm. Okay. As you may recall, we said the book value of the firm is equal to shareholders' equity. The book value of the firm, $200,000. Another way to think about book value of the firm, we can, if we think of the accounting equation as A equals L plus E, we can rewrite that as A minus L equals E. And so that's what we're seeing here. Another way to calculate book value is just focus on equity from our accounting equation. Equity is equal to your assets minus your liabilities. Debt is another word we use when we refer to liabilities. So we would take 220 minus 20 to get $200,000. Or just directly look at shareholders' equity, 200,000. All right. Oftentimes we put book value on a per share basis. Talk later on why we do this. You may recall when Bill Jackson started the company, he contributed $200,000 in exchange for 10,000 shares of common stock. So to calculate book value per share, we take the book value in total divided by the number of shares. So 200,000 divided by 10,000, and we get $20 per share. So that is the book value per share. It has nothing to do with the market value, what the stock is currently selling for. That's the market value per share. This is the book value per share. All right, this question, how the firm obtain its assets? You'll be asked this from now until the end of the course. It's just 3 places your assets can come from. They all come from the right-hand side of your equation. So it comes from your liabilities, and it can come from equity. You may recall shareholders' equity has 2 major components. It has common stock, or also known as contributed capital, or paid-in capital, and the other part is retained earnings. So liabilities, another word we use is debt, right? So the 3 sources of assets, where assets come from, they will come from either debt or equity. It's the only place they can come from, debt or equity, which is liabilities or shareholders' equity. And then just recall shareholders' equity is 2 components. The paid-in capital / common stock and retained earnings. So in this example, we look up, well, from liabilities, we have 20,000 in liabilities. The amount from equity, from paid-in capital, from common stock is 200,000. At this point, there's no retained earnings. Haven't had any earnings yet, right? So the amount from earnings, 0. So these are the same 3 sources. Debt, represented by liabilities, and equity, represented by the paid-in capital, referred to as common stock for now, and retained earnings. So again, always from the same 3 sources, right? Now the big question is going to be, all right, well, how do we start getting some retained earnings? What are we going to do with these assets? We've got these cars sitting here. What are they going to do with them, right? So I'll have to keep you in suspense. To keep reading on to find out what happens. So that is it for me. So again, if you have questions, you can ask me, you can ask your instructor, but good luck.